Good afternoon, all. Thank you for joining us for our first Cowry Asset webinar for the year 2023. The theme of the webinar is the Nigerian Economic Report Card, a full review of year 2022. My name is Folake Osho, and I'll be your moderator for the session. Without further ado, permit me to please introduce the MD CEO of Cowry Asset Management, Mr. Johnson Chukwu. Mr. Johnson Chukwu has over 3 decades of experience cutting across the banking industry, the Nigerian capital market, the oil and gas, and various sectors of the economy. He is also a fellow of both the Institute Chartered of Accountants and Chartered Institutes of Taxation. He is a well-traveled individual, and he has had several courses across national and international bodies, such as Harvard Business School and Stanford. Before I leave the floor for the GMD, please take note that we have a Q&A box for questions and answers, because we'll be having a question and answer section immediately after the GMD's presentation. We are so glad to have you here, sir.
Thank you, everyone. Happy New Year all, and once again, welcome to our webinar, our quarterly webinar. I'm going to share with you the presentation so that we speak through that, and like Folake said, we can take question and answer from the participants. Let me start from the So once again, like I said, you're welcome to our first quarter class. It's actually a review of last quarter of 2022 economic outlook, economic performance, and the outlook for 2023. So of course, we know that last year was an eventful year in the global economic space. We know last year, the war between Russia and Ukraine started in February, I think February 24th, 2022, and that the global economy went into a spin as a result of the war. We saw a situation where energy prices skyrocketed, food prices skyrocketed because of supply bottlenecks, as well as a continuous COVID lockdown in China. Of course, Nigeria was not left out of those countries that suffered some collateral damage from the war. But Nigeria's situation was also peculiar in some ways, in the sense that a lot of the challenges we faced were endogenous to us. So I'll just take us through the presentation, and then starting with the executive summary. So like I said earlier, we saw an eventful year in the economic and social space globally. We saw an upsurge in crude prices. I think crude prices at the first 12 months of the year averaged more than $100 in the first 9 months of the year. In the first 11 months of the year up to November last year, it averaged more than $100. Principally, I think about $103, principally because of the war and the decision of OPEC members to keep a lead on crude production, OPEC and OPEC Plus. Of course, added to that, we had the issues around the Western countries imposing restrictions on Russian oil. At the last count, they have put a price cap on Russian seaborne oil supply to Western countries. All these factors constrained supply, global crude oil supply, and led to an elevated price of crude globally. The implication of an elevated price for crude is that energy costs shot up. Of course, we also know that there was also an increase in the price of gas, and Russia, being the largest exporter of gas in the world, was a major factor in the gas equation. So we saw gas prices skyrocket, we saw crude prices skyrocket, and related to crude price, we saw the price of other white products like fuel, PMS, AGO, which is diesel, and the ATK, which is aviation fuel, as well as dual-purpose kerosene, which is our household kerosene. All the prices went up in the year, and that had direct flushed into inflation rates globally. We saw high rate of inflation. As we speak today, the IMF is projecting that about a third of the world global economy is going to go into recession in 2023. Of course, we've seen a slowdown in the major economies, the US, Europe, and China. And we know US is the largest economy, China, followed by China. Then the European Union as a body, as a bloc, it seems to be the third largest economy. Of course, but when you take them out individually, they are not the third. But going on to that, we saw election in US, where a midterm election, and in that election, the Republican Party retook control of the Congress. Of course, last week we saw an election for the Speaker of the House of Rep of the US Congress, and the Republican member retook that post from Nancy Pelosi. So which means that today we now have a split legislature in the US, which will kind of constrain Joe Biden from passing some of the very expansionary fiscal policies that the Republicans are known for. This will mean that there may be a break in some supply to the most vulnerable people in the US and the world. The outgone year also witnessed in fact, bloodbath in many stock exchanges. The S&P lost about 20% and the Nasdaq lost about 30%. Last year, we also witnessed the first major collapse of a crypto operator, one of the big cryptocurrencies that collapsed last year, the FTX. And there are concerns that the contagious effect of that collapse could affect other cryptos. Of course, that has actually brought to the fore the need for some form of regulation of the crypto industry, because the impact of FTX collapse has begun to affect even mainstream financial institutions. Then China, for the first time in a long while, China saw exodus of foreign portfolio investors away from its economy. Of course, China has witnessed the longest lockdown based on COVID. China started lockdown in 2020 and they continued lockdown through 2022. It just yesterday, last week, that China began to open up the economy. They have accepted the fact that this restriction will not work. Of course, the report I saw yesterday said about 80 million people have now been affected or infected by COVID in China in the past few days. The UK also witnessed its own political turmoil. We saw the election of the immediate past Prime Minister, I think Liz Taylor, who short reign created a lot of economic upheaval in UK. But interestingly, they were able to address that quickly, and now has elected Rishi Sunak as the leader of the government. That immediately saw some level of stability in the UK economy. We've seen a moderation in inflation rate. Of course, they're also going through some difficulties. We're now witnessing the past few days, strike upon strike. The rail workers are on strike. The health workers are on strike because there's been a huge rate of inflation in the UK, particularly food inflation that has worsened the standard of living of an average British citizen. So people, employees are kicking for higher wages, and they've been going on strike to compel the government to index their remunerations to the rate of inflation. Of course, we know the UK economy is vulnerable. We saw the UK economy contract by 0.3% in the third quarter of last year. And the impact of exiting the European Union has begun to affect Britain in more negative ways than positive. Going further to what we saw in the global economy and the outlook for this year's economy. We've seen the IMF and World Bank they now have downgraded the global economic growth rate to about 3.2%, estimated economic growth rate for 3.2% this last year, and they are forecasting that the GDP growth rate, global economic growth rate, will further slow down to 2.7% in the current year. For Nigeria, their projection is that our GDP growth rate will be 3.2% last year, and this year, current year, about 3%. But if you look at what we have achieved last year, you observe that the third quarter of the last year, we only grew by 2.25%. So far this year, we've grown by about 2.9%. Of course, we know all the factors that have driven slowdown in economic growth rate, particularly the decision of most central banks to adopt very severe contractionary monetary policies to slow down on fund flow or access to funding or increase the cost of funding, which has constrained these sector productive activities. Nigeria was not left out of that. By the time we move further, you will realize that even the manufacturing sector in the country contracted by 1.9% in the third quarter of last year, principally because there is high cost of funding, which the asset conversion cycle will now allow them to borrow at those rates, and the fact that there is low consumer demand as a result of weakening consumer purchasing power. So, like I said, we saw last year a spike in global inflation around the world. Nigeria was plateaued. Of course, we don't have the December figure, but as of November, our inflation rate had gone to 21.47%, up from 21.09%. That applies to several countries. Of course, countries like US and UK are beginning to see moderation. The US inflation has dropped to 7.1% from a 7.7%. Similarly, the UK is also moderating. Inflation rate is moderating. But those rate moderations are far from their target. The US target is about 2%. At the 7.1%, that's still materially higher than what they project to be, which means that it's expected that the US Federal Reserve Bank will continue to apply the brakes. We saw an increase of 50 basis points at the last meeting of the Fed, which was an improvement over the increase of 75 basis points in the preceding meeting. But irrespective of that, we think an inflation rate of 7.5% is such that will make them continue to apply the brakes until we see a further improvement. That applying the brakes comes with a cost. Like I said, the global economy is supposed to slow down. Growth rate is slowing down this year, and it's supposed to slow down further next year. And some, like I also mentioned, that the IMF is already projecting about a third of the global economies will go into a recession. So if you look at the US economy, for instance, like I said, you saw inflation rate drop to 7.1% from 7.7%, despite the target of 2.2%, which is still materially higher than that. Of course, major factor driving inflation is energy costs, food costs in most of these jurisdictions. I did mention that there's been a change in government in UK, twice changes in government, or 3 times changes in government, from Boris Johnson to Elizabeth Taylor to Liz Taylor, and now to Sunak. And all those factors were partly, of course, Johnson left because of political reasons, because of personal conduct in government, or weakness in his core values as against the societal expectations. But then Taylor left because of failure to manage the economy. The investing public had no confidence in their capacity to manage the economy. And now Sunak is down up there, and is beginning to have positive impact on the UK economy. Okay, so I said earlier, we've also seen a moderation in inflation rate in UK in November since Sunak was elected the prime minister. Prior to that in October, they had an inflation rate of 11.1%, which was the highest since October 1981, when some of the people in this webinar were not even born. So that could imagine the impact of that, which is what had led to a series of strikes in UK, including border. I think a friend of mine said he had to go back to UK because the border police or the border control officers were going on strike. On some days had given notice of going on strike. So it's been a comedy of strikes in UK as a result of this inflationary pressure. So I'm saying this so that we can put in perspective how people react when increase in costs of goods and services erode their standard of living. But interestingly, we are at a 21.47%, and we're moving on as if nothing is wrong. China, we're basically touching on some of the key global economic drivers. Like we said earlier, China is the second largest economy in the world, and China's growth has slowed down, principally because of the severe lockdown, what they call zero tolerance for COVID. But they've also come to realize that it has not worked. The impact of that lockdown on the economy has been quite severe. We've seen a slowdown in China's economic growth rate to just about 3.9% in the third quarter of last year. But having said that, China had just recently reopened its borders to allow free movement of people and goods and services and individuals. But the interesting thing is that the China opening will have multiple impact on the global economy. One is that we're going to see a resumption in supply, an improvement in supply chain. A lot of goods and services, goods are produced in China. Some of them couldn't be produced to meet supply needs. So, and that led to part of the inflationary pressure because the price of those goods had to go up. So with China reopening, you're going to see an increase in the flow of both capital goods and consumer goods into the global economy. But coming with that will also be a higher demand for crude because this is a major feedstock in terms of energy supply. So energy demand will also increase immediately China comes back from their normal annual holidays. I think the holidays should be starting any moment now if we have not started. So China is going to have a direct impact on the global economy in terms of supply of capital goods, supply of consumer goods, as well as demand for input materials. Russia, interestingly, of course, we know the story is that when Russia started the war, the Western countries slammed sanctions on Russia. It had a skyrocketing of its inflation rate, currency depreciated. But because Russia had continued to sell crude to India and China at the minimum, and continued to even sell gas to the Western countries, we've seen a continuous moderation in its inflation rate in the past 5 months or so, from the peak that it reached in February when the Western countries slammed it with sanctions. We've also seen, of course, the impact of the sanctions are beginning to wear in on the economy. We've seen a slowdown in economy. We've seen the economy shrank by 4.1% in the last quarter, second quarter of last year. Then the Eurozone, which is the third biggest economic bloc, if you take it as a single economic bloc, after US and China, has also gone through severe inflation rate. We've seen inflation peak at 10.6% in October, though moderated to 10.1% in November. We've seen the European Central Bank tighten monetary policies. Of course, that is also expected to continue because their target is 2%, but they are far from 2%. Why am I saying this? Because with tightening of monetary policies around the world, a couple of things happen to countries like Nigeria. One, we no longer witness so much of portfolio investments because returns on in those economies become better than the risk associated with returns from an emerging economy like ours, which is also why some non-crude exporting African countries have almost unraveled in the past 12 months, Ghana being one of them. So I had mentioned in the course of our conversation that our GDP rate had actually slowed down from a 3.5% to 2.25% in the third quarter of this year. This decline in GDP, and we need to put it in proper context, because if you look at the distribution of the GDP, you realize that agriculture accounts about 26% of the GDP, trade accounts for 15.35% of the GDP, telecommunication 15.35% of the GDP, manufacturing about 8% of the GDP, and then oil and gas about 6% of the GDP. If you look at that, the agricultural sector grew by only 1.2% in the third quarter of last year. The telecommunication sector was the one that actually propelled most of the growth, about 10%. Trade grew by about 5%, but then manufacturing sector contracted by about 1.9%. What that means is that the economy has remained fragile, driven, and then the oil and gas sector contracted by more than 22%. So for policymakers, the question they should ask themselves, how do we sustain the growth in the telecommunication sector? And that growth was driven largely by data services. And then how do we restore growth in the manufacturing sector? The problem with the manufacturing sector is that they are now facing severe increase in costs. Energy costs, most of them are running on diesel. Diesel price at the pump head is about 800 naira or 830 naira for the urban areas. Outside Lagos, it could be higher than that. And then because you don't have stable supply from the main national grid, electricity grid. And then they also have to deal with higher interest costs. Most banks have revised their lending rate upwards. And the manufacturing sector, like I mentioned earlier, is not suited for high interest rates for their working capital, because the asset conversion cycle is longer than those of trading entities. So these are the figures I had mentioned. The agriculture sector grew about, contribution is about 29.6%. The trade sector about 15.35%. Info and telecommunication 15.3%. Manufacturing about 8%. Mining about 6%. Real estate. So you can see the growth. I did mention the agriculture sector grew only by about 1.34%. The trade sector 5%. Info communication at 10%. But then my agriculture contracted, manufacturing contracted by 1.9%, and mining contracted about 21.2%. If you focus only on oil and gas, the contraction is about 22%. So this gives you a pictorial presentation of how our economy is. Since the past 8 years, we've seen the economy oscillate from a contraction of 1.5% in 2016 to another contraction of 1.92% in 2020. The highest performance so far achieved in the past 8 years was last year's growth of 3.4%, which was driven by what we call the base effect, because there was a contraction the preceding year. So anything growing from a lower base will indicate kind of an improvement in growth, but in reality, it was partly, a recovery of the previous year's decline. The major growth driver was the non-oil sector, which grew by 4.27%. That non-oil sector I had mentioned earlier was driven by telecommunications. So in terms of size, of course, financial services grew by 12%, but financial services account for just about 3.4% of the GDP. It's not so huge, but although its impact is quite significant. Back to the issue of inflation. I'm going to talk on what has driven inflation so far in the year, last year, and the measures adopted by the government, by the central bank to fight inflation. The inflationary pressure we have witnessed has been driven by 4 major factors. One is insecurity in the country, which has weakened food production, and therefore, because we are not producing enough food, the food being produced is now coming to the market to face higher demand. So core problem of inflation is food inflation. And that's why the food inflation came at the print of 24% in November last year. The second contributory factor is the pass-through effect of depreciation of local currency. The currency has been depreciated because you're not producing enough crude. And because you're not producing enough crude, you don't have enough reserve and you cannot defend the local currency. So the second factor is pass-through effect of depreciation of local currency. Third factor is the cost of imported energy inputs, like the cost of diesel, the cost of fuel. The fuel in some locations is now going for as high as 300 naira per liter, and diesel is going for more than 700 naira per liter. So these are factors that are driving inflation. And then the fourth factor is the ways and means funding of the federal government by the central bank. I'm going to speak more on the debt situation of the country. The debt profile on the books of the government balance sheet of the DMO is about 44 trillion, national debt. And then we had about 22.7 trillion that needs to be securitized. When you throw that in and you add the last year's deficit about 6 trillion, then you'll be moving to close to 70 trillion or 77 trillion that is now being bandied around as our national debt. So because the central bank has continuously funded the federal government irrespective without recognizing the limitation posed by the CBN Act that you cannot fund the federal government by more than 50%, and it must be paid back before has not been the case. And these factors have driven inflation to 21.47%. But there are concerns that inflation could worsen further in the coming months because, one, we saw devastating flood in the month of November, September and October. And the impact of that will manifest in food prices in subsequent months. Particularly products, staples like rice, will see a lower output as a result of the flood. So this is expected to affect further the food inflation, which will dovetail into all item inflation. So I think we've spoken a lot on what has happened. Of course, we know the implications of inflation. You have a decline in your purchasing power, which could lead to a decline in the standard of living of average citizens, which is the reason why people are protesting in UK and going on strike almost on a daily basis. But here we seem to have thick skins to navigate or to survive situation has. I talked extensively on insecurity because if you look at if you disaggregate the food inflation, you find that major drivers are cereals, tuber. Tuber, we talk of is yam, potato, cassava, and these things are produced locally. And they talk of cereals. So you realize that a lot of the food items that we are challenged with their prices are largely because of insecurity in several parts of the country. The federal government, the monetary authorities have adopted to try to they started increasing monetary policy rates in May last year by increasing the rate by 150 basis points to 13%. Today, they have increased the rate by as high as 500 basis points or 5% to 16.5% since they started the increment. They also increased the cash reserve ratio by 500 basis points from 27.5% to 32.5%. All this were in efforts to fight inflation. For those of you who have been following my comments on fighting inflation, I've always emphasized that we need to go back to the roots of the inflationary pressure, that you cannot fight this inflation using the same tools that used to fight inflation when it was driven by money supply. The money supply component of it I had mentioned is coming from ways and means. It's not coming from great expansion to private sector players. It is when money supply is coming from private sector monetary expansion that you can fight it with increasing monetary policy rate. But that's not the case. If you want to fight that money supply, you have to fight the volume of cash that you are advancing to the federal government by ways and means. So in any case, those tools have not worked effectively because the core of the inflationary pressure we're facing today is not driven by great expansion. And that's why, despite that fight, we've seen inflation continue to accelerate over time. We've seen inflation right from when that we started increasing the food. Total inflation was about 15.9% in May, but now we are up to 21.47%. I'm gonna paper through the currency design because I guess all of us are really familiar with that, because we're not going to dwell on some of these, but we are going to get this report ultimately. We saw the central bank came to announce to Nigerians on November 23 that is going to change the redesign three of the currencies, the 1,000 naira note, 500 naira note, and 200 naira note. And then that has the new currency is in circulation now. The central bank also came back and announced the limitations on amount of withdrawals. All these things are pointing to the fact that the central bank is trying to curtail the availability of cash for election purposes, beyond the other reasons that we are given. Some of those reasons are unassailable, reasons that when they want to fight the issue, reduce the availability of cash to people who are involved in kidnapping, availability of cash for payment of ransom, to those who are into illicit businesses like drug trafficking, and as well as availability of cash to those who use it for nefarious activities like buying Nigerians' conscience by buying votes. So those, like I said, are unassailable arguments where no one can fault. And I've also said that the benefit of a cashless policy is that you are going to deny criminals the access to liquidity, cash liquidity. And once they can't get cash, like those who are collecting cash for ransom, they are not likely going to continue to kidnap. If head or tail, they will not be able to get the cash. But the basic thing that's information available is that the central bank has also come to announce that the withdrawal limits have been increased to 500,000 naira per week for individuals and 5 million naira per week for corporates. And that should you want to withdraw more than that, you're going to pay 3% for individuals and 5% penalty for corporates. And that if you have a critical need to withdraw up to 10 million naira for corporates, you have to go through some protocol, including getting the MD of the bank to approve it. And then you pay your the cash handling charge of 5%. So I think what could be the benefit of that? I've talked about the benefit as it relates to reduction in crime. There's also convenience if you have to pay through the other means of payment. And then the cost of handling cash will likely come down. But the benefit for the government is that if you have, it will lead to some level of formalization of the economy. It becomes easier for government to track the revenues of businesses because their transactions will now go through the formal financial system. And that way the government can do, at the minimum for those who do not file their tax returns, the government can impose, based on judgment, taxes on such corporates. So it may end up giving the government the better tools or better resources to tax properly. Then I had mentioned that part of the problem we have had that led to inflationary pressure is because we're not producing enough crude, and then the pass-through effect of absence of enough foreign exchange earnings is that the local currency continues to depreciate. So there is a nexus between our crude production, our reserve, and our exchange rate. Crude production actually plummeted last year to just about 972 1,000 barrels, I think in October or thereabout, or November. But interestingly, at the same point, our OPEC quota was 1.383 million barrels a day in October and 1.74 million barrels a day in November. We were far shy of those OPEC quotas because of shorting and the oil theft. But there is the government seems to be responding now that we've got a crisis situation where the banks are all canceling any form of dollar withdrawal on local currency issued cards, local currency debit cards. So the government has engaged some security consultants or ex-militants, which is actually the right name for them, to now police the pipelines. There was an announcement that crude production has gone back to about 1.2 million barrels the past couple of days. And we hope that will be sustained. But this year's budget is predicated on 1.69 million barrels a day at a time when our average production last year was far less than just about 1.1 million barrels. So it's going to be a tough call for us to achieve that budgeted provision for crude production. But most importantly, if we do not increase our crude production, we're going to continue to suffer depreciation of local currency. We're going to continue to suffer higher inflation as a result of pass-through effect of depreciation of local currency. And these are the realities of the ground. Our debt, I had made mention of that. We've seen a debt profile rise to about 44 trillion on the books. And then you still have a huge amount that the federal government is asking the National Assembly to approve for it to be securitized. And that bond, the DMO has proposed a bond of 40-year bond. The current 20-year bond in the market is trading at between 15%. And the government is planning to issue a 40-year bond. The central bank, which will be the holder of this bond in the primary market, will end up underwriting it. And when they underwrite it, then they have to now flow this into the market, and nobody will buy those bonds at 9%. So you're going to see a situation where the central bank will sell those bonds at material discounts to reflect the quality yield in the market. And if 30-year bond, if the 30-year bond is trading at about 15%, will come at a pricing at higher than that, which means it could come at a yield double the coupon on it. And that will mean that the central bank will have to lock in a lot of capital loss if he has to offer to the market. Just to bring some context into the debt. Apologies, I think my network had a brief break. So I wouldn't know where I was last heard. Can somebody just comment to me the last thing that you heard me say, so I can take it from there? Folake, can you tell me, did we get to?
We stopped at 27, sir. Slide 27, sir. Talking about the. Okay, so back to the debt situation I was talking about. The issue that we are gradually moving towards a Ghanaian situation. Ghana's debt has become a crisis. Ghana's city suffered the greatest loss of value
globally in 2022. Ghana has defaulted on local currency debt and foreign currency debt. And Ghana is restructuring both local currency and foreign currency debt. Sometimes Nigerian will tell you that, look, Nigeria has a debt to GDP of 22%, which is a fact. But the problem is that the revenues are strained and the government does not have enough revenue for the current debt profile. At 877 trillion naira, the debt service will certainly be more than 80% of government debt revenue. And that would be a burden, a major burden to the next government. Now, moving on to trade. Our international trade position turned positive last year. In the first 9 months of the year, we saw a positive trade balance of about 3.4 trillion naira, which ordinarily will mean that there should be an accretion in our reserve, but there was no accretion in the reserve. The only accretion we saw was about $70 million that happened last month or last week. But the major thing is balance. When you now look at the invisibles, you realize that the government, the central bank there's still a lot of cash outflow from invisibles. That is payment of school fees, payment of medical services, remittances for dividend payment, remittances for other services rendered to the country, and similar expenses that are paid that are not part of the trade that are depressing our reserve. They are $40 billion, but ended the year at $37 billion last year. So now let's look at the budget, because when we now look at because a journalist asked me, does the budget have any impact on the economic performance of the country? I said, look, basically, budget is the only tool, is the most important fiscal tool that the government uses to shape the direction of the economy or stimulate economic growth. The government came up with a budget revenue estimate of about 21.83 trillion naira, budgetary revenue about 9.7 trillion naira, a deficit, all in cumulative deficit about 11.34 trillion. And if you look at the breakdown of that budget, a couple of things we need to emphasize in the budget, which, because of the audience, we need to ask Nigeria, we need to continue to say such things. There are 4 illegalities in the current year's budget, and I hope that subsequently we have to remedy it. The first one is that the budget was passed before the Finance Act. The Finance Bill is supposed to be a precursor to the budget, because the assumptions on which the budget revenue is based on are derived from the Finance Act or Finance Bill. But fortunately, the Finance Bill was not signed into law. The Fiscal Revenue Act stipulates that before the budget is actually presented, the Finance Bill is already considered and passed into law and signed into law. That's one. Second factor, we saw a budget deficit provision at about 5.03% of the GDP. The Fiscal Revenue Act stipulates that the budget deficit should not be more than 3% of the GDP. So ideally, the National Assembly should not pass a budget that contradicts an existing law of the country. 3, the National Assembly approved the administration of the life of the 2022 budget to March. At the same time, the 2023 budget has been signed into law. 2 budgets cannot run concurrently. The only reason why you extend a fiscal plan is if the other fiscal plan was not, the subsequent fiscal plan was not ready. But this time around, we're going to have 2 budgets run concurrently when most components of the previous year's budget have been rolled over into the new budget. So I don't know how that will be taken. And then the 4th one is that the government has not paid back its borrowing from the central bank. There is a provision of internal borrowing, local currency borrowing, of about 7.09 trillion naira in this year's budget, 2023 budget. And that will largely be funded possibly by ways and means. So ideally, the law says that until the federal government pays back the previous outstanding fiscal borrowing, borrowing from the central bank, it cannot be advanced for that amount. But those things we are all overlooked. And that's why some of us feels that the 2023 budget will at best be a piece of document that will be in the drawing board until the new government comes in. Because if you have extended the new year, but last year's budget, how you going to continue to run the two budgets concurrently? But the only consolation is that this budget will be certainly reviewed by a new government. And again, a lot of the provisions of the budget are such that the assumptions on which the budget was based, I had mentioned the issue of 1.69 barrels a day, 1.69 million barrels a day. If you look at these assumptions, you can see that some assumptions have already been, even before the budget kicked in, has been overtaken by reality. Apart from the crude oil benchmark of $75, which I think is achievable, if you look at the crude production of 1.69, you agree with me that's optimistic. You have an exchange rate of 435 to $1. We're already talking about 451, 451 at the I&E window. There is actually no market today where you get 435. Even the official government windows have gone above 435. So why use 435? When if you use the appropriate rate, you would at least provide obligations. Then you look at the inflation rate of 17.616%. I had mentioned the stock extensively on the inflation rate of 21.47%, and the fact that the inflationary outlook is still steep, is still negative. Some of the factors that would drive inflation rate, I've talked about the flooding in major food belts of the country, the high continuous insecurity in the country. But again, we're also seeing continuous increase in energy costs. The Minister of State for Petroleum said yesterday that that we have to accept the reality of buying fuel at between 180 and 300 naira. The impact of a 300 naira fuel will reflect on food price, on commodity prices, including food prices. There has been a surreptitious increase in electricity tariff that will increase the average consumer prices. These are factors that will be reflected in subsequent months in the consumer price index, and that means that a 17.16% inflation figure looks too conservative. If you go further down, you look at the GDP growth of 3.75%. IMF is projecting you're going to grow about 3% this year. Even last year's projection also seemed to be unachievable. So you can see why I say that the budget seems to be a bit optimistic. Now, let's look at the different market segments. You have the equities market. Last year, equity market did quite well. We saw a market year to date a rise of about 20%, 19.98%. So far this year, as at close of business yesterday, the market has grown by about 0.8%. The first week of the year was a bit choppy, but the first trading day of this week was quite good at over 0.9% growth. So if you look at the indexes that have seen that drove the growth of last year, you see the oil and gas index. The major contributor here are the likes of Seplat. Of course, the oil prices, like I said, traded above $100 as at up to November last year. You have the industrial goods index. That sector also enjoyed a boom until the last quarter, until we began to see impact of increase in interest costs begin to reflect. And like I said earlier, the consumer goods have suffered principally because of low purchasing power. And then the banking index, the banking sector grew by 12%. So the banking index has seen a growth of about 2.8%. The insurance industry has been the whipping child. I mean, the insurance index seems to be the whipping child because even in the industry itself, there are also challenges with the issue of capitalization, which the regulator has been prevaricating as it relates to capitalization, and they also issue a revocation of licenses. These factors have impacted negatively on the insurance index. So these are the top gainers and the top losers for the year. So you can see the multivans gained a whopping 1,890%. You saw Wema Bank gained 394%. You saw Thomas White gain 177%. You have Academy, you have Champion, you have Lean Africa, and then you have PZ. And then on the converse, you see legal insurance, livestock feed, Covington, UPL, Resta, UPDC credits, and the Honeywell, Flamis, and Japol, all leading the trail in terms of bad losers. These are the major acquisitions that took place in the year. You have the VDF, you have the Nenebreak Advisory, you have the Access Holding acquired First Guarantee, and they also acquired Sigma. I think that's the biggest acquisition we actually saw. Then they sold their first custodian because Access custodian because the regulation stipulates that you cannot have both custodian and administrator. Then you had the Fidelity Bank acquire Union Bank UK, and then Seplat acquisition of Mobile is still not conclusive in the sense that the regulator have not granted their consent for that acquisition. And then another big bank was Titan Trust Bank acquiring Union Bank. So the VFD is a core investment, not really an acquisition. VFD invested in NGX and holds 5% of NGX today. But the other ones are acquisitions. But for Seplat, which is an inconclusive deal as we speak, the others we are also conclusive. So these are the major acquisitions that happened in the year, in the outgone year. I've talked about the banking industry's contributing index, banking index growing by 2.81%. In terms of the banking industry, the outlook for the industry is quite positive in the sense that, look, we are now dealing with higher interest rates, and I'm going to speak of the positives and the risk the banking industry is exposed to today. One, we've seen the banks are enjoying a much wider net interest margin because the depositors have not been able to get commensurate repricing of deposit liability interest as much as the banks have been able to reprice their loan books. So we're seeing an increase in net interest margin of the bank, which are reflected in a very positive performance of the banks. The likes of Fidelity Bank for the first time in its history to pay the interim dividend. So the bank, some of the major bank operators are going to enjoy that windfall from higher interest rate. But the flip side of it, you should expect an increase in non-performing loans because once you have this level of interest rate, you will find out that many business operators will not be in position to meet their interest payment obligations and the principal repayment as at when due. So the banks that will write this are those who have very strong risk management capabilities, very strong credit appraisal process, and those who are playing in the high end of the market where you have the corporate customers who have strong cash flow, but they also don't enjoy the level of margins that mid-tier customers also pay. So the industrial goods sector, I had mentioned that the oil and gas sector was the largest performer. The industrial goods sector was the second largest best performer in the year. And what is the outlook for that sector? We think as we approach the election, a lot of things will now depend on how the election plays out. The operators in that sector have some level of insulation from economic vagaries. The challenge they will have is access to foreign currency to be able to import raw materials. I had said earlier that the China is reopening, which means industrial goods import will improve, and that will help improving their access to critical input materials for production. The likes of Dangote Cement, Bua, and Lafarge, who are the major players in that sector, like I also said, they are bellwether operators. Unless there's a major economic political upheaval, their products are demanded by both private sector consumers and government, public sector consumers. So whenever the public sector is not focused on consuming, the private sector takes a lap. And those operators have actually enjoyed very good return in the past year. Then you have the oil and gas sector. I've mentioned that the major driver of that sector is Seplat, which has enjoyed a huge boom because of heightened crude prices, and as well as its ability to navigate the challenges of the issues around the Niger Delta. Seplat seems to have evolved a mechanism for dealing with local people within its operational areas. And I think the government should go approach Seplat to take a template of how Seplat have never to do that. I had mentioned earlier that we should expect higher, continuous, stable crude prices, if not even higher crude prices. So operators in that sector, the likes of Seplat, will continue to enjoy a boom. So it's a peak for discerning investors. NNPC has been discussing the issue of getting listed on the exchange, and we're hoping that a new government will ratchet up that. I had mentioned extensively that we've seen an improvement in crude production as a result of the security agreement that the government has signed. This will also help the other operators. Unfortunately, most of the operators in the upstream sector of the oil and gas industry are not listed. The ones that are listed are the downstream operators. The downstream operators are going to face a certain period, a certain time in the coming months. One is that virtually all the political actors have a common consensus that they will take out the subsidy. So when they take out the subsidy, then the operators in the downstream sector will need to import products directly. The questions are, will they have access to FX, or what method will be used to ration FX? It will now be dependent on who has access to FX, and that will now determine the fortune of operators in that sector. So for investors, you have to be very discerning in taking positions in the downstream stock until we know the direction that things will take after the expected deregulation of that sector. Then the telecommunications sector. I had mentioned in the course of our conversation on the sector that grew, that the ICT sector grew by about 10% and was driven by data services. The outlook for that sector is very rosy, and I will tell you some of the reasons why it's very rosy. One is that they have just acquired, both of them have gotten their payment service banking license. They've been appointed as even revenue collectors by the government. They have been appointed to collect VAT and a couple of other revenue from government. They will get commission from those things. But as a payment service bank, they're going to gradually begin to displace the POS terminal operators, given the cash limitations now imposed by the central bank. Another factor is that we are going to continue to see a boom in data services. Both Airtel has been awarded a 5G license, just like MTN had won the 5G license previously. So you have now 5G license operators. Two of them have operational facilities already in place, already operating businesses. And it then means that you're going to see a rollout of 5G across the country. And that would mean that data consumption will increase and the revenue from that will also improve. So give and take, we think that sector is in a good position to command investment in the coming period. Consumer goods. This one sector that grew marginally, negatively last year by 0.06%. You can say it was flat last year. The key thing is that this sector is impacted negatively by what you call consumers' disposable income, which have been eroded by inflation. With the inflation of 21.47%, it simply means that what you used to afford last year, you can only afford just about 82% or 87% of it today. Not 77% of it today. You can no longer afford the quantity of goods and services you used to afford the previous time. So what people are doing is they are rationalizing their consumption and focusing on priorities or essentials. So the consumer goods sector will continue to be under pressure in the coming year, although there are operators who have now adopted some level of fractionalization of their products, and then you have small units or smaller sachets of their product to make it available or accessible or affordable to the average poor consumers in the country. But give and take, I think that sector will may not record a very major boom unless the economy bounces back. But you have to also make some level of discrimination when you talk of that. The brewery sector, the brewery subsector, seem to be a bellwether as well, particularly in an election period. So a lot of consumption in subsequent child of this public confidence, ability or willingness of insurance companies to pay claims, insurance policy premium, and that will likely have some impact if it's properly enforced on the once again, the network, and that's why we are praying for the 5G to become effective so that we won't be going through these hiccups when we are talking to the public. So my apologies again. I'll go back and reshare my presentation. I was talking about the insurance industry before that break. So, so the basic thing is that the insurance industry is still an infinitesimal contributor or the poor cousins to the banking industry. A couple of things have to be done. One, the industry has to be strengthened in terms of capitalization. The regulator has to also be stronger. And then there needs to be cleaning up of weak operators or recapitalization of the weak operators. So in summary, the equities market will be driven by situation. The outcome of the political the election that's coming up in February. My take is always that a lot of things that will be underpinned on the outcome of the political process that we're undergoing now. If we get it right with the election and elect the right candidate, we should see a boom in the economy. The investors will come back to the economy, including local investors, as well as foreign portfolio investors. People will take positions on the bargain hunting will become the order of the day. People will take position on stocks that have intrinsic good values but are underpriced. These are factors that will likely drive. And then you look at the interest rate environment. Of course, we know when interest rates are high, investors will underweigh their portfolios in equities and overweigh them in fixed income instruments. The Eurobond market will remain, we've seen a major bearish activity because of increases in monetary policy rates globally, particularly the Federal Reserve Bank, the Bank of England, the European Central Bank, and which has led to outflow of capital back to some stable economies, and then exit from toward or what we call frontier Eurobond market. We've seen Ghanaian Eurobond become a junk. At some point, Nigeria's Eurobond was approaching a junk status. And then Angola, but Angola has fully recovered because it has strengthened its reserve. We've seen a major decline in inflation rate and a major decline in the yield on Angolan bond. But all said and done, we've seen the emerging market Eurobond suffer from investor apathy. But that also presents you good opportunities if you are discerning. Not that you go and buy a junk bond like Ghana that is now renegotiating terms with investors. But we are of the opinion that Ghana must be very circumspect in how it does the negotiation, because otherwise it will damage the economy for a very long time. Should it ride a rough sword on investors, then you should expect the investors will blacklist them for as many as 20, 30 years. And that won't be good for the economy of Ghana. Local bond market. I had mentioned the federal government is trying to come to the market to issue a 22 trillion bond. And there are a couple of things, concerns we have that bond. The total value of institutional fund in the economy today is less than 80 trillion. The banking industry had about 54 trillion in total deposits. And then you have the pension fund industry about 14 trillion naira in total deposits. Part of, in the funds under management, part of the funds under management residing with the PFAs are either already invested in federal government bonds, federal government instruments, and money market instruments with the banks. So in effect, total available institutional liability funds under management in the country is not up to 80 trillion naira. So it will be difficult for the market to absorb a 22 or 23 trillion naira of federal government bonds that come into the market afresh. Should that happen, they're going to crowd out the private sector. Because when you talk about the 64 trillion naira of total banking industry liability deposits, remember that a significant part of it is already lent out as loans. So we think the federal government, should they come to the market, you're going to see a material rise in interest rate or yield on bonds and a decline in bond prices. The issue around the FX market is very clear. We've talked about that. I did say earlier that the exchange rate and the I&E had gotten to 456. And that the government is still budgeting about 435 as the official rate for the 23 budget. And I think that, I said that has already been taken by time. We are talking about the market about saying 40 naira. The key thing there is that we must improve crude production for us to have a more stable exchange rate. And hopefully, by the time the new government comes in, we pray that they have a line of sight on how to deal with the insecurity in Niger Delta, as well as the insecurity across the country. It's only those factors that will give us some respite in the short term. But we also believe that should Nigeria choose wisely, we should begin to attract both foreign portfolio investors and foreign direct investors. These are factors that will help us stabilize the exchange rate. So in the short term, the exchange rate, the currency will still remain under pressure. We do not imagine that government will achieve the 1.69 million barrels a day crude production, because you are talking of average daily crude production. So in effect, there is a consensus among all the key contestants on the issue of removal of subsidy. The general election is very key to where we will be, how the economy will be positioned, and even the Japa syndrome will also reverse should we elect the right candidate. Because once the economy begins to grow, we should expect that Nigerians in diaspora want to come back to this country that has 365 days of summer, unlike very cold climate where many of our brothers and sisters have migrated to. National consensus is coming in at the same time when election is around the corner. We hope that the election outcome will basically make whatever is the outcome of national census no longer to be a sensitive political issue. We've known that census figures have been very contentious in the past and could be a spark to social crisis, but we're hoping that a successful election will put that in abeyance. The FX pressure is likely going to continue in the first half of the year until the new government comes into play and begin to make announcements that brings confidence of foreign portfolio investors and foreign investors in the country, as well as stabilize or improve crude production and stabilize the situation in the northern part of the country. What are the key factors we need to look at? Diversification of your portfolio. I've talked about some segments of sectors of the economy where we should expect an uptick with telecommunication sector is one area to invest in. In the oil and gas sector, Seplat is there for as good investment. The downstream sector, be very circumspect in what you want to invest. But the key thing is spread your investment and then don't be very bullish at a period of pre-election year. So what you need to do is largely stay in the short end of the market. The money market, Cowry Asset has multiple instruments you can invest in the short run. We have mutual funds that will give you some level of stability in terms of return. We have our fixed income fund, we have our mixed fund, and then we have our equity funds. That way you diversify your portfolio by investing in a broad asset category, even with a small amount of money. I had mentioned the issue of that at the point when we're approaching an election, you have to be cautious in what you want to do. You need to understand the market and remain liquid. Cash is king, particularly in an unstable environment. I think we'll take that's the end of my presentation. I'm sure many of you also know Cowry Assets. We have become an investment supermarket. We have subsidiaries in securities trading, Cowry Securities Limited, which is a trader and a member of NGX, FMDQ, and NASD, and is trading on all the market segments. We can also help you buy instruments locally and externally outside the country. You have our fund management. We have 3 mutual funds. 2 others are coming into play. We have the Eurobond we expect to come in the next few weeks. And then you have the dollar fund that may also come in the next few days. So we are an issuing house with financial advisors. We help you manage your portfolio. And that's about all. I will wait to hear your questions, and thank you all.
Thank you so much for such an insightful economic analysis. I was particularly taken by the simplified 4 reasons for inflation, the cause of inflation, and also the positive look you've shared on the reduction of cash for both corporate and individuals and the impact it had on kidnappers. Thank you so much for that. Right now, we are set to dive into the question and section, and we have some questions here for you, sir.
Okay.
Okay, so we have from Andy. Do you think the central banks will continue their hawkish approach, given that inflation is very high, although growing at a slower pace, also taking into consideration that the government is growing at a slow pace? Are developing countries like Nigeria faced with recession fears?
Okay, do I take the questions? I think maybe I take 2 or 3 questions.
Okay, so from Innocent, we have, what is the likely method of regulation to adopt in the crypto exchanges to bring back institutional money and trust in the space? I think we'll take 2 at a time.
Okay, starting with Andy's question, do I think that the central bank will continue its hawkish monetary approach? As long as the central bank believes, and the central bank governor has said this repeatedly, that they will continue their hawkish monetary approach. As long as they believe that increasing interest rates will solve the problem, they will. But I'm clear in my mind that when they put a couple of things will give in, there's what we call every economic policy will have some level of lag effect. Lag effect will mean that the impact does not come immediately. Some of the issues I mentioned, the issue of increase in number of millions will happen. And then when the default begin to happen, the central bank will now be looking for how to fight that or how to set up another bad bank. And it's at that time it will dawn on us that the current approach will not solve the problem. I had mentioned the issue that led to fuel inflation. And as long as those issues have nothing to do with whether I've gotten money from central bank that I'm spending, I've borrowed for consumption, then you won't solve it with this. But the approach of the central bank has been, we will continue to step on the brakes, hoping that will fight inflation. If the central bank really want to step on the brakes, the first brake to step on is to stop lending to the federal government, because once you lend to the federal government, ways and means, you stimulate liquidity. If you look at the report from the Bureau of Statistics. They said, look, as at November last year, the money in circulation, the currency circulation increased by 11.3%. If you compare to the GDP growth rate of 2.25%, you are having excess liquidity. Where is it coming from? It's not coming from credit expansion. It's coming from ways and means. I had mentioned a report I read said that by October last year, that the government had borrowed from the central bank about 6 trillion naira. That went into consumption that was not backed by goods and services produced. So that's the way to fight inflation. But that's it. The central bank has a different approach. The innocent asks, what is the likely method to use to regulate the crypto industry so as to bring back institutional investors? The key thing about the crypto industry is that the private issued cryptocurrencies are not amenable to regulation in the sense that the coins are created by individuals. There is no parameter for determining the coins you must create to make sure you maintain some level of stability. So what I think will happen is that the central bank issued cryptocurrencies will eventually begin to compete with private issued cryptocurrencies. And maybe by the time the central bank issued coins are not generally accepted as alternative to private sector issued cryptocurrencies, the private sector would align with some level of discipline that are inherent in the central bank issued cryptos. Remember that the key thing about crypto today is that it's not so much for its value as a medium of exchange, but more for its value as a as a speculative tool. So people who are buying privately issued cryptos are buying it for speculative purposes, not necessarily as a medium of exchange. And irrespective of the fact that it's supposed to be a currency and should be a medium of exchange. Of course, there are some institutions that accept them, but those institutions are not yet broad, and the main motivation that people buy is for speculative, that they go up and they will sell. So when it is that of a medium of exchange, then the volatility in it will have to be addressed, because once that volatility continues, it cannot serve as a good medium of exchange.
Thank you for the feedback, sir. So we have a question from Joe Boy. What is the best investment strategy to protect one from rising inflation? And from Jimo, how do we manage our increasing debt profile?
Jimo is, how do we manage our rising profile?
Yeah, increasing debt profile.
Increasing debt profile. Okay. I'll start with Joe's question. Which is, what is the best investment strategy to protect from rising inflation? The first thing is that, like I mentioned earlier, we are going to launch a Eurobond fund in the next couple of days or in the next couple of weeks. And then we also have a dollar fund. So if you have an income in dollars or you have a means of getting dollar, it's the best way to is to ensure that, one, you protect yourself against Naira devaluation. Naira devaluation is part of the problem we're having that is leading to inflationary pressure we're facing today. Two, that you also invest in a basket of instruments like in a mutual fund. When you invest in a mutual fund, you are likely going to invest in assets that will move in some, not in a single direction. So that way you have a weighted return that it may not beat inflation immediately in the current environment, because we do not have the latitude to just invest in any country because of lack of convertibility of local currency. But you can invest in a mutual fund that will give you some returns. And then for now, I would recommend that you look at our fixed income instrument fund, our money market fund, then those instruments will likely, because our strategy is to continue to invest in such a way as to follow the market or move ahead of the market. Because when we see a trend, we take a position ahead of that trend. Today, you can get reasonably good return on money market instruments, on fixed income instruments, if you know how to play the market. So I think, but the key thing is look for a knowledgeable advisor to handhold you in making your investment, and do not go long time. Do not go long term now until we begin to forecast that inflation will moderate. When we begin to forecast that inflation will moderate, it's time to go long time before this inflation starts moderating. So you lock in on long-term assets at good yield, even when short-term instruments will begin to generate lower yield. At some point, you're going to see what we call an inverted yield curve. An inverted yield curve will be when longer dated instrument will begin to give you yield lower than shorter dated instruments. Then, Jimon, how do we manage our increasing debt profile? Well, a couple of things we need to do, and in this case, not you and I, but let's hope that one or two government people may be in this meeting, is that one, the government needs to eliminate what you call discretionary expenses. And part of those discretionary expenses are fueling our debt. This year alone, the first half of the year, the government has borrowed 3.36 trillion naira as subsidy. But who is subsidizing who? You are buying fuel outside Lagos at 300 naira per liter. So if the fuel is going at 300 naira per liter, Nigerians are buying it without any whimper protest. So why don't we eliminate the subsidy immediately today and let fuel go for 300 naira? And then the government will save us 3.36 trillion naira. That alone will reduce our borrowing this year from 11.3 to something like 8.3 or just about 8 trillion. Then we also need to look and review our approach to investment in infrastructure. Some infrastructural investments are highly commercially viable. So if those ones are commercially viable, why don't we allow private sector to build them? Private sector will build them at a lower cost, at a more efficient rate, and then the burden will not be on the national treasury. Because every kobo we're going to invest in infrastructure this year will be borrowed. You are borrowing 11.3 trillion. You are only investing in infrastructure of less than 6 trillion. So if you are doing infrastructure of about 6 trillion and you are borrowing 11 trillion, so it simply means every kobo that will go into infrastructure is borrowed. So look at those infrastructure and look at those ones that are commercially viable and focus on social infrastructure. That way, assuming we take out 6 trillion and take out another 3.3 trillion, you would have taken out about 10 trillion, which means you have almost eradicated the deficit for this year's budget. Then before we talk of other smaller issues about rationalizing the ministry agents and departments to reduce the government overhead. But the key thing is that it has to be taken, this will be taken by a government that has a strong political will.
Thank you, sir. So I have a question from Rose. Rose says that what will be the direct implication on inflation if fuel subsidy is removed in 2023?
Is there any other question so that we can take all of them now?
Okay, and we have a question from Ezine. Why with the continuous rise in our debt, inability to recoup massive revenue, and our shrinking reserve, is there any chance that Nigeria will face the problem that Ghana is facing in paying off their debt? Should I repeat the last question?
I got all the questions.
Okay, sir.
Okay, let's start with Rose's question. What will be the direct implication of removing fuel subsidy in the current year? Well, in the first place, for an average consumer outside Lagos, they're already paying near commercial rate for fuel. Those in Lagos and Abuja, and maybe Port Harcourt, may be enjoying subsidy. So what will happen is that we're going to see some level of uptick in prices of goods and services. But remember that food is produced in rural areas. The people who are bringing food from Benue, from Boko, from Otukpo, coming to Lagos, they're already paying the commercial rate to bring fuel. most of the transport vehicles are using diesel, so diesel is fully deregulated. The people in the rural areas are buying fuel at commercial rates. So they are already witnessing the full impact should fuel be deregulated. You're going to see some uptick in urban inflation, but then it will not be so material because prices are already adjusted. Any day you buy fuel with a jerry can, you have bought at a commercial rate. So in effect, some of those prices are already factored into our inflation. It may not have been reflected fully, but because, like I said, I talked about that lag effect. By the time the impact of the current fuel scarcity reflected on consumer prices, then the additional impact of a removal of subsidy will be minimal. Then Ezine asks, would Nigeria face the kind of problem that Ghana is facing in terms of debt crisis? Well, I wouldn't say yes or no. It depends on which government comes in power in February. And that's why we all have to vote wisely. If we vote wrongly, we're going to face a similar problem. Because at 77 trillion, if you don't know, if we continue in the current trajectory, I had mentioned to you some of my own thoughts of how we can win ourselves of this continued debt accumulation. But should we continue the current trajectory? In the next 3 years, we'll be having a debt of maybe 200 trillion naira. Certainly, we will not be able to service it, we will not be able to pay it back, and we'll run into a problem. So it's all about you and I taking the right decision to vote a person who will not continue in the current trajectory, and we have a change of course for the economy and understands how to manage the economy well. So if we get it right with the election on February 25th, then we will begin to address this problem. But the continuous movement in the current direction will certainly lead to calamity.
Thank you for that fantastic feedback, sir. So I have a question for me. Considering our current debt profile, macroeconomic instability caused by excessive liquidity injected by the CBN, what reforms do you think we need to introduce?
Well, the reforms will be both physical and monetary. On the physical side, I've talked about how to reduce the need for government to borrow. The key thing will be to grow the economy. If we grow the economy, which is why I'm particularly interested in getting it right with the election. Like I said, everything we're going to talk about this year will depend on how the election plays out. Then you will begin to see investors into the economy. Nigeria is one of the countries that most positioned to take advantage of the global crisis we saw last year and last 2 years. And I'm going to emphasize that today, the Western countries are looking for a country that will take away the special privileges that China has today as a major manufacturing hub of the world. We are a country of 200 million people. We are projected to be at about 400 million by 2050. By 2050, we're expected to be the third most populated country in the world after India and China, because India would have overtaken China by then. It then means that we have an average median age of 25. We have a life expectancy of 55 years. We are one country that the world is looking at. Get your politics right. We want to invest here for manufacturing activities because we want to reduce the risk of the world depending on China for all product manufacturing activities. The Western countries are looking for alternative energy supply source away from Russia. Nigeria is one of the countries laden with so much of gas deposit that is unexploited. They are looking, if we get it right with leadership, to invest in this country. So if we get it right with leadership, which is a choice you and I have to make, then we should expect a deluge of investors coming to the country, which will help us grow our GDP beyond about $450 million today. To make
Thank you so much, sir.
Because servicing at the fiscal. Okay.
Okay, thank you very much. This will be our final question. So what's your opinion on securitization?
Mine.
Hello, sir.
I don't know whether we're asking a question, but were you asking a question?
Yes. I was asking a question. Please,
Okay.
Can you explain the ways and means securitization and how you think it will go at the 9% proposed rate and 40-year tenure and the legality?
Okay, you didn't tell me the person who asked that question. I think we should also
Anonymous.
Okay, anonymous.
This is the final question.
The ways and means securitization is that what they want to do is that the federal government is owing central bank about 22.8 trillion naira. That is running as an overdraft in the books of central bank. A securitization will simply mean that the central bank will issue bonds worth 22.8 trillion naira, and then they will sell those bonds. And when they sell those bonds, when the bond become an asset, they sell those bonds, and the cash proceeds will come back to central, which they will now use to replace the debt the central bank, federal government is owing them. So in effect, federal government will now be owing the public, those who buy those bonds. So that's the way it works. So in that case, in 40 years' time, the federal government will pay back that those bonds will mature. It become like any of the federal government bonds. So it will mature in 40 years' time. At that point, the federal government would have grown its revenue profile to be able to pay back. So that's what they want to do. And that bond, they want to issue at 9%. So if you're holding that bond and you buy at the time of issuance, you'll be getting 9% coupon. But like I said, no instrument today is trading at 9%. So it will be impossible to sell it to the public at 9%. I think we begin to round up. We've done an hour 30 minutes.
Yes, thank you, sir. If you have any other questions, please forward them to our email, info@cowryasset.com. info@cowryasset.com. Thank you very much. GMD has done justice to all the questions. And most importantly, he has provided a detailed retrospective context of the past year, while also giving us insight of the year to come. Thank you very much. I'll use this opportunity to invite the head of internal control of Cowry Asset Management, in person of Mr. Daniel Oudo, to please give us a vote of thanks.
Good afternoon, everyone. And I want to say thank you for participating. It's been a pleasure to have you on board. To all our participants online and those that were unable to join, I'm sure the link is available. We appreciate your time. We appreciate the fact that you stayed with us to be watered with an insightful position as to how Nigeria is going to turn out in the years to come. We are grateful to all our participants. We appreciate you. We know that this knowledge being passed down is not wasted, and we're sure you're going to do something about it. To know is one thing, and to do what you know is another. Please don't let this knowledge go out. Try to take it on board. If you have, like my colleague said, if you have further questions, further insight you want, either a one-on-one insight or you want to get further information as to how the economy will unfold, so as to take knowledgeable position with your hard-earned resources, given Nigeria's devaluated currency, it is important that this knowledge sticks with you. So we thank you for the time. We know you've invested your time and you will surely reap the benefits. So on behalf of Cowry Assets, all its subsidiaries, and our Group Managing Director, Sir Johnson Shukun. We say thank you to all our participants, and we are appreciative of the fact that you are here with us. And yes, we are here to ensure that whatever information and knowledge you require as to how financial market works, financial investment works, and what to do with your funds, either in your youthful age or in your old age, you can always count on us. We are here to give you, yes, so that you know this is a regulated business, so there's nothing you should be scared of. Thank you so much for your time, and thank you, Sir Johnson Chukwu. It's always interesting to listen to. I mean, there's nothing more a plant would want than water, air, and sunlight. Thank you.
Thank you very much, Mr. Daniel. Please note that all participants will be mailed the presentation slide earlier presented by the GMD. Thank you all for joining in, and thank you for being an amazing audience. We sincerely hope that you have enjoyed the webinar as much as we have, and our next session will be happening later in this quarter. We'll be sending our invitations via our various social media platforms and other platforms. Thank you very much, and God bless. Bye.